Yes, hello and welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
And we talk every week about the reality of running property businesses. Simon owns Buy-to-Lets and created Patma, a leading portfolio management software system and a source of property market insights.
And Stuart runs a portfolio of co-living properties with a six-figure turnover.
And as always, quick request before we get into the show today. If you haven't yet joined our email tribe, please do. The link is in the show notes below. Just click there and add your details and we'll add you to the link. We do have finally some onboarding emails, and the intention is that very shortly we will start sending out some market insights that are created actually by Patma, but will be of use to anyone considering or in property investing. So just reach out to the link in your show notes below and you can join our BOP tribe. So today's subject of conversation is around Simon's property investment. And those of you that have listened over the last few weeks, probably months, will know that Simon has been in the process of buying and has completed on his next property investment. So I think we should just get straight into it, Simon, in terms of let's outline what you were looking for in terms of financials and property. And then we're then going to talk about what Simon actually got. And then we're going to find out if Simon's actually happy with that. So, Simon, let's talk about what you were looking for.
Well, first of all, you mentioned that whether people have been listening for the last few weeks or months, or in preparing for this recording, I was thinking, how long ago was it that I actually started this purchase? And I thought it must be at least a year. And I looked it up, and it all started with the sort of first offers last June. So it's not quite been a year. So it feels a bit longer than it has been, but it has still been quite a while. So what was I looking for? I was looking for a simple, relatively hands-off buy-to-let investment that would provide a steady return, not super exciting, just a good place to store some money and not lose value over the long term, and hopefully have some income along the way. Back then, if you can remember, that the property market was going a bit crazy, everything was a bit hot, things were selling in days or weeks at the most, and finding anything to buy was actually quite difficult. And interest rates back then were still also really low, although we could see that increases were probably coming up. And that, I think, made me look at lower returns as being fairly acceptable, but not crazy low. And it also meant that I was looking for property deals a bit more than perhaps I might normally be, because the market was a bit too hot to be going in on everyday properties that were coming up and selling really quickly. So I was looking for properties that had fallen through and might have a more motivated seller. And I was also looking for properties that weren't too expensive. So one of the ways that was sort of coming up in things I was looking for is properties that often needed a bit of refurbishment. I wasn't too afraid to go in and do some painting and some other bits and pieces. And as it turned out on this one, a little bit more. But yeah, so standard buy-to-let, simple, steady returns over the long term. And given the market at the time, the returns didn't need to be super exciting, just reasonable. And the property itself, I was looking for sort of a bit of a bargain, and I was trying to find that through refurbishment and fall-throughs.
Okay, so I think obviously let's talk about numbers. So when we talk about what we're looking for, let's talk about the numbers. But before we did that, I just had one question, because I think this is quite pertinent to anyone that is thinking about the same approach. And it's quite interesting, I think, for investors that you'd already highlighted, actually, I'm going to look through fall-throughs, and we know that you can use Patma for that. So little plug there to do that. My question is, what did you think made you the right person or buyer to kind of, profit from that situation? So what put you in a good position? Because other people might say, well, I'd look for fall-throughs, but then if I'm going to buy it the same way, if I'm going to buy it on a mortgage, would I be any better or worse? So what did you felt put you in a better light?
I think I would hope that I could move relatively quickly. We can discuss whether that turned out to be the case or not, but that would be my hope going into it, that I know what I'm doing. If it's a property I want to go for, then I can move fairly quickly. I've got reasonable, or I had reasonable deposit available. So I couldn't have done it without a mortgage, but I had some flexibility around the exact mortgage levels and things like that. So yeah, a reasonably strong position to be buying from, but certainly not the best. I mean, I was not a cash buyer by any means. So yeah.
And do you know? Last question, because I think the numbers are the interesting bit for to get an understanding of what your thinking was before you went into this. But did you know the person that fell through was a residential buyer as opposed to investor buyer?
As in the person who was going to be buying the property that I ended up buying, you mean?
Yeah.
I think they were residential, but I don't know for sure.
Yeah. Okay. So
actually, I can add that I do know they were going to be paying an awful lot more than I paid.
Very, very interesting. Okay. So what was your target purchase price range, and what were the sort of yields that you were looking for, ROI?
So my price was really decided by the money that I could put into it, the investment. And I was hoping at that point to be able to purchase 2 properties with the funds I had. Longer term listeners will remember that a few years back I sold a property, and I had equity that came out of that property that was available for reinvestment in new properties. And that combined with some other funds, but my intention was to purchase 2 new investment properties to replace the one that was sold. And hence that was sort of really my driving factor on price. I wanted to take the deposit money I had, or the investment money I had. It doesn't obviously just go on deposit, it goes on stamp duty and all the rest. And I was dividing that by 2. So as we will dig in, plans change over time. But that was my plan going in. And when I first looked at this property, I was expecting to be putting in a total investment of just under 140,000, which was within that 50% bracket that I'd sort of set myself. But it was relatively close to it. But yeah.
Okay, and so what yields were you targeting with that?
So this one is a bit sort of more complicated to answer. So the yield in the estimates that I put together when I was considering my offer for this property, the yield and ROI estimates come out at a 5% yield and about a 3.3% ROI, which was sort of in my bracket of acceptable. I didn't have a strict limit on here. I mean, I know some people will say, never look at an investment that's less than 10% yield or less than 5% ROI or whatever their cutoff is. And I did not and do not have a strict cutoff on any of these things. My real intention was just that it would not do significantly worse, and may even do slightly better, but certainly not do significantly worse than holding the cash and putting it in a savings account. And at the time, 3% ROI was better than you would get in a savings account, a lot better. As I said, things change over time, but that's where we were back then.
Okay, so I guess the curtain lift is what you did actually spend and where it came out in the end against your projections, and yeah, what your feelings are.
Right. So, so as I said, I purchased this, or I agreed to purchase this back in June last year, and that process went through a sort of couple of iterations. So the property was on the market for 400,000, and my first offer after I'd been to visit and had a look around and things was 350,000. They came back and we went through a couple of sort of iterations of negotiation, and the agreed price we settled on was 360,000. So it was a lot less than sort of the asking price, but in my view, the asking price was what it would have been worth. Well, in that market, maybe slightly more, but only very slightly. It mostly would have been what it was worth in a sort of fully fixed and nice-looking state, which is not the state that I found it in. So the property needed work. So the property generally looked like it needed definitely a repaint. The previous owner clearly had pets, or a pet at least, and they were also a smoker. So the inside of the property smelt a bit and was discoloured and various other things. So it needed some attention. And there was also the ensuite that was in really bad shape. So it was very mouldy, and some of the walls, they're just stud walls and things, but some of the walls were damaged, water damaged and things like that. So going into it, I'd gone round and I'd looked at it and I thought, okay, definitely need to replace the ensuite, need to repaint, might need to recarpet, might need to do something to the kitchen and things like that. And my worst case budget, because I wanted to be buying this with worst case in mind to make sure that it would work. So my worst case budget was £30,000 for the repairs and refurbishment and whatever else. And realistically, I was thinking that that's worst case, but I think probably 15,000, 5,000 for new ensuite, and then 10,000 to recarpet, repaint, some minor repairs, bits and pieces like that. So I was thinking sort of 15,000, but worst case budget 30,000. So the figures I mentioned earlier, the ROI and yield and things, are based on the worst case of 30,000 refurbs.
Simon, I feel like you're teasing us here. So what did you actually spend?
Oh, I'm not sure I should reveal that yet. But we need to keep people listening to the end. I think we should just talk generally and then just in the last 10 seconds mention the actual number. Okay, maybe not. So what did I actually spend? Not sure I actually want to confess this, really.
Good. Well, it sounds like we're going to get some juicy knowledge here.
So the refurbishment took longer than expected. So there were incidental costs related to that. So
we want numbers, Simon.
So paying the mortgage, paying council tax, paying utilities, etc. And I'm not including those in this initial number. The actual refurbishment work ended up costing £38,000.
Wow.
So that was a little bit of an overspend.
This, dear listener, is why Simon was dragging this out, because he actually didn't want to tell us that he was basically 25% over budget. Okay, so we went over budget there.
And this is, I should probably, while I'm making the confessions, I should probably also admit that it cost more to actually buy in the first place than expected as well. Because when I initially did my forecasts and things, I was expecting a 75% loan to value buy-to-let mortgage on it. And during the purchase process, so after I'd made the offer and had it accepted and was then sorting out the details of the mortgage, the lender that I wanted to use came back and said, well, actually, we don't want to give you 75%. We just want to give 65%. And I mean, they had their reasons, but we're not going to go to those today. But that's obviously a big difference. 75 down to 65. That's a big chunk of extra deposit you have to put into the property. And I had to sort of go back to my figures and check that this worked and things. And there was another alteration at the last minute in the mortgage as well, which meant they were actually offering that 65% on a lower valuation. But anyway, too many details. The end result is that I had to go back to my figures and decide whether I could still do this. And I decided I could, but the total investment that I was putting in had gone from about 140,000 up to about 170,000. And bear in mind, this is still on my predicted worst case refurb of 30,000. So in the end, and indeed the world had changed by the time I was making these decisions. So interest rates were going up, mortgage rates had gone up. So one of the reasons why I was willing to stick with this 65% loan to value rather than shift to a 75% at a different provider was because I wouldn't get the same interest rate. I'd end up paying another % or perhaps more on the interest rate. So yeah, it's all sort of balancing one thing off against another. But the end result was that I stuck with the mortgage provider, accepted a lower loan to value, accepted that I'd put more cash into the deal, and accepted that it meant I would not have as much capital to go again for a second property, which is still the situation that I'm in now.
I think this is standard property for anyone that's been in property for any length of time. We say it because we know it's true, is that, whatever number you think you're going to spend, add more. However long you think it's going to take, add more time. And that's just simply property. So in terms of getting down to the nitty-gritty parts of it, where did you get to in terms of the rental figure, in terms of what you actually now receive versus what you thought you were going to receive, and how did that transpire into your actual gross and net yields versus what you were hoping for?
Okay, so this is where there's a little tiny bit of good news. My estimated monthly rent when I put the offer in was $1,500, and I thought that would be sort of maybe not absolute top end, but I thought that would be sort of a good finish, good refurbishment, good quality, good rent. So it's not necessarily top of the range, but it's certainly not bottom of the market either. So $1,500. And then when I actually put it on the market to rent a month or so ago, I put it on for £1,575, so £1,575 per month. So that was an uplift of £75. And demand was actually so high that I had multiple above asking offers. And the one I ended up going for was £1,650 per month. So the actual rent I ended up achieving was £150 a month more than I was expecting in my original forecasts.
Yeah, 10% higher. That's good.
Indeed, that was quite good to balance out some of the other mistakes along the way. So in the end, when you actually put all that back into the mix, so I put more money in, the refurb took longer, more expenses, the refurb costs itself more than I expected, deposit that went in more than I expected because of the reduced mortgage. So in the end, all of that was much higher, but the rent is also now a bit higher. So allowing for all of that, my current expected, assuming nothing disastrous goes wrong, return on investment is actually 4.1%. So I haven't actually ended up doing too badly from the looks of that. And this is a property that was purchased in a limited company. So I'm including in that, it's the first purchase in this limited company, so I'm including in that accountancy costs that will, in the fullness of time, be shared across multiple properties, but at the moment are all coming off this one property. So yeah, it has scope for getting better as well.
And just quickly for those listening, Simon talks about ROI and we're talking about yields, and we also talk about ROC. If you want to know what we mean by those terms, please just go back to episode 12, long time ago. But we do sort of break down what we're talking about in those terms. So go back to that. So 4.1%, how did that match up against what you were originally hoping for?
So my original estimate back in the long distant past was 3.3%-ish, which I mentioned earlier. And then when the mortgage issues came about and that moved figures around, because I had to put more capital in, it actually reduced the payments, and hence my ROI actually went up a little bit. So it was actually nearly 3.5% was my sort of predicted ROI at that point. And now, of course, it's actually turned out to be about 4.1% return on investment. So yeah, it's not too bad. And just to sort of throw in an extra little tidbit, if you look at that after tax, in a limited company, you're only paying corporation tax, so that knocks it down to 3.3%-ish return on investment after the corporation tax if you leave the money in. And then if you were to take that money out as a dividend, then in the reality, that's probably not what you would actually do. But if you did take it as a dividend and you were a higher rate taxpayer, then you'd end up with a 2.1% ROI after all of the tax. So that's not actually too bad, really. And especially if you compare that to what you'd be looking at if you bought in personal name, you would have ended up with roughly a 1% after-tax return on investment. So it's definitely looking more positive for limited companies these days.
And just to go, because I think some of these figures are, so ROI, I don't typically work with myself, but I guess what a lot of people do will think about this in terms of this investment versus another investment. So when we look at your figures, so for example, you said £170,000 was the cash requirement to purchase, as in the money you needed to put in against the mortgage. Is that right?
That was the pre-exchange, pre-completion expectation, yes. I then overspent on the refurb, so had to put in more in the end, but yes.
Okay, so that was a total figure. So your total cash in, so the money that your limited company had to put in was?
Just a smidge over 190,000 in the end.
Okay, so you've put £190,000 in, and then just sort of breaking this down. And can we talk about the net rental figure?
Yes, certainly. So the annual rent on £1,650 is £19,800, and I've got an annual mortgage cost of £9,170. I've got estimated other costs in there, and this is some service fees for the estate that the property's on, and general sort of maintenance allowance and things of about 1,470 is what I put in. And then I've got accountancy costs for the company, which is £1,250 a year. And that all works out to be a sort of net rent income of £7,900, give or take, which is about £650-ish a month.
Yeah. So even now, though lots of things have increased, your figure of sort of 4.1, 4.2% ROI, or what could just be considered a rate of return against that, in my mind at least, is still pretty good. And the next thing I think about, and the reason why I guess we all love property it's twofold, is we haven't yet talked about the appreciation that the property will get over time, because obviously you buy for very long term, so at least 20 years, if not longer, and we know that typically over time that's going to increase. But the other thing that I always like to look at, because I have done a lot of my numbers were return on capital employed, because we were looking at increasing value. So not just doing the refurbs that you've talked about, but obviously doing refurbs, adding en suites, increasing the quality of the property, so that actually we were forcing a greater value and then trying to get more capital out. But I find it quite interesting. So even if we think about, so if we take away the money that you just needed for your deposit and your SDLT, so your cash requirement, which we worked out roughly was with refurbishment and everything else, I think was around 45,000, for example. I had a quick look at that, and essentially your net rent, and obviously would pay that off in 5.7 years. So that would reduce your capital outlay, which obviously then increases your rate of return ongoing. And that's obviously not accounting into the consideration that you may get a better mortgage at some time. There may be a rental increase, he says with his tongue in his cheek, because we know what we're like as investors. We tend to not poke the bear, but we definitely should. So actually, overall, that to me looks like a good investment, because even 4.1% pre-tax. But interestingly, when I just looked at the net yield, so which is total value of purchase price, so your net rent divided by the total purchase price, was coming out at 2.2. Now, I know some people that say they don't get out of bed for less than 5. So initially, some people might say that doesn't look great. What say you?
Well, I think that, as you said, we would expect some capital growth, and probably in the long term, the capital growth would be above inflation, but it certainly shouldn't be less than inflation. So if I was to take this money and put it in a savings account, I would take that capital amount, put it in a savings account, and these days I might get a 4% return. So that's my return on investment, 4%. However, in 10 years, when I came to take that capital out of that account, it would still be exactly the same number that I put in. And I mean, yes, interest might compound and et cetera, but let's assume not. The end result is I get the same number back of pounds. Only those pounds are now worth significantly less than when I put them in because of inflation. However, when I've taken those pounds and I've put them into a property, and we're going to ignore the effects of leveraging here because we're going to keep it a bit simpler, but those pounds will increase in value at least in line with inflation. So I get my 4% return, my 4% interest, if you like, from comparing to savings, and the capital value of the cash that I put in doesn't stay at the same number. It does instead stay at the same value, roughly, maybe even higher, in the long term. And to sort of counter that in the short term, I purchased this house for £360,000. I then spent £40-ish thousand on refurbishment and looking after and things while it was being refurbished. And in the current market, I think it's probably valued at about £360,000. At which point you might think, well, I've just lost 40 plus thousand. And perhaps I have, if I had to crystallize the value or with the current value, which thankfully I don't. So my expectation is that I will hold it long term, 20 years plus. But for this illustration, I've just gone for 10 years. And I have assumed that the value will fall further for the next couple of years. Not significantly, but a little bit. And then I have assumed that the value will increase for the next 8 years after that. And that would be at a rate of between 3 and 4%. So I've done some years of each. Allowing for that, across the whole 10 years, the return on investment, or the capital gain, perhaps I should say, is the capital gain. It's not return on investment particularly, but the capital gain would be over £50,000, and that would be at 2.8% roughly a year, it works out. So I don't think that's too shabby, really. And it means that the total returns across monthly profit from rent and capital gains would be running at over 6%. So yeah, I think the capital gains helps save the property in this particular area. And that's even allowing for its current value having gone down and some more drops and only fairly steady price increases after that. Historically, in this area, the annual house price growth for the last 5 years has been running at 6%. So I think my estimates are on the low side.
Great. Well, I think we know the answer to this then, because when we look at the numbers, even the fact that, you know, using your own view, it's possibly an overspend on the property. Actually, just in simple terms, if you put that money anywhere else, around 4% still sounds very good. But then when you supercharge it with, over the next 10 years, the capital appreciation, actually the investment gets better. And so that leads to the final question, Simon. Overall, are you happy with your investment?
I'm a bit frustrated at the process on multiple levels, including with myself in some areas, which we should probably dig into on another episode. But yes, I am overall happy that this investment is good and will work in the long term.
So there you have it, listeners. We hope that this episode has really just brought to life, the thinking process that Simon has gone through and we go through when we're doing investments and how we measure that. And we may well have the therapy session that Simon needs to get over some of his frustrations on a future episode. If you would like to hear that, do let us know. Just reach out to us at biz of property on Twitter, or drop us a line at show@thebusinessofproperty.com. Hope you've enjoyed the episode. If you have, do leave us a rating or review. And other than that, we'll see you on the next episode.